On February 28th, the United States and Israel struck Iran. Within hours, the Strait of Hormuz, a 55-kilometer choke point, went dark. That single narrows normally carries about 20% of global petroleum and LNG. When it closed, more than 11 million barrels per day of Gulf crude was curtailed. The IEA's Fatih Birol called it the largest energy crisis in history. Canada's TSX Energy sector took notice. The S&P TSX Capped Energy Index delivered a 46% return in 2026 through mid-May. Individual names ran harder. Cenovus was up 84% year-to-date by mid-May. Brent crude, which sat below $80 per barrel entering 2026, spiked past $125. The question every TSX Energy holder is now asking is, what was the market actually pricing? Two camps have formed, and each rests on a different unstated premise. Camp 1 says the market priced a temporary geopolitical disruption premium. Under that reading, ceasefire talks progressing means the premium dissolves. Camp 2 says the market began pricing a structural re-rating of Canadian energy's value to global buyers. Under that reading, the premium doesn't dissolve with a ceasefire, it becomes the new floor. The distinction matters because it determines whether this week's pullback is an opportunity or a correction. Here is what the articles don't put in the same sentence. Even under Wood Mackenzie's most optimistic quick peace scenario, Strait reopens by June, Brent only eases to around $80 per barrel by end 2026. That number was the starting price when the year began. So the bull case for oil doesn't remove the price gain, it locks in a higher medium-term floor. And Canada's TSX producers are operating with cost structures built for a much lower world. Strathcona Resources, for example, breaks even at $41 per barrel. It can fund growth and its dividend at $58. At $80, it is generating free cash flow the market had not modeled at the start of 2026. That changes the denominator in every valuation framework applied to this sector. By late May, ceasefire optimism had pulled TSX Energy stocks lower. The surface narrative was simple. If the Strait reopens, the risk premium fades. But this framing contains an unstated premise that deserves scrutiny. The consensus conclusion, sell on ceasefire progress, logically requires the premise that the oil premium is entirely attributable to the closure and will fully revert. That premise is not supported by the data. Crude started 2026 at $56 per barrel and was trading near $105 by late May. Even after the pullback, prices remain nearly double the pre-conflict level. Wood Mackenzie's summer settlement scenario, where the Strait stays largely closed through September, projects a shallow global recession but acknowledges that oil prices remain structurally elevated beyond the conflict window. More importantly, global strategic reserves have been severely depleted. Goldman Sachs reported that as of May, global oil stockpiles were drawing down at 8.7 million barrels per day, a record pace. The U.S. Strategic Petroleum Reserve was also being drawn down fast. Reserves that took years to accumulate cannot be refilled in weeks. Even if the Strait fully reopens, the physical replenishment of global inventories takes months to years. That inventory gap is not a geopolitical premium, it is a structural supply deficit. And here is where the two camps diverge at the premise level, not the conclusion level. Camp 1 assumes the price corrects because the cause, the Strait closure, resolves. Camp 2 assumes the price corrects only partially because the effect, inventory depletion, persists independent of the cause. TSX Energy stock's free cash flow yields are priced largely by Camp 1 logic this week. Strathcona trades at 8 times free cash flow with a 12% free cash flow yield. Cenovus, after its 79% year-to-date run, still trades at 8.4 times free cash flow. Those are not stretched multiples for companies generating cash at oil above 80. The holder's question is not, do I believe in the ceasefire, but do I believe in the inventory replenishment timeline? That is a different risk variable than the market appears to be pricing. The ceasefire debate consumes most of the energy airtime. But there is a second catalyst running in parallel that neither side of that debate has priced. AltaGas ships propane from Canada to Asian markets. Before the conflict, approximately 1.3 million barrels of propane per day reached Asian markets through the Persian Gulf route. When the Hormuz disruption hit, that supply was cut off. AltaGas filled part of the gap. The spread between the Asian propane price and a local North American domestic benchmark has more than doubled since the pre-conflict period. That spread is not a temporary ceasefire premium. It is a structural repricing of Canadian propane's reliability value to Asian buyers. The same dynamic is now playing out in LNG. On May 27th, Canada announced its first ever LNG supply agreement with a European buyer. Germany's state-owned utility Cefi signed a deal to purchase 1 million tons per year from the Xi project in northern BC. The deal runs for up to 20 years, with deliveries starting in the early 2030s. The Germany angle is not obvious from geography alone. The logic is that Alberta-sourced gas sells on North American markets for $3 to $4 per gigajoule. In Germany, the same energy sells for 4 times that. Germany, shut out of Russian supply since 2022 and now facing Middle East disruption from the Iran conflict, was willing to pay for reliability. The Xi announcement is a direct transmission from the Hormuz disruption to Canadian infrastructure's long-term cash flow story. Even if a ceasefire restores some Middle East supply, Germany has now committed to a 20-year diversification away from that region. That commitment does not reverse with a ceasefire. Canada's midstream and LNG infrastructure, AltaGas, the Xi-ism's consortium, and the pipeline networks feeding them, have structural demand locked in on a multi-decade horizon. The pullback in TSX Energy stocks this week does not reflect this second-order transmission. The market is looking at the Hormuz headline and missing the contract lifecycle running beneath it.
The hook of this analysis was a Japanese supertanker completing something unremarkable 18 months ago. The Idemitsu Maru transited the Strait of Hormuz in late April and docked around May 25 with the first Persian Gulf cargo to reach Japan since the conflict began. That is a data point, not a signal that the blockade has ended. Iran has reportedly begun demanding transit tolls from tankers passing through the strait. The proposed rate is $1 per barrel, payable in Bitcoin and Ethereum. This is not symbolic. It is Iran monetizing a choke point while sidestepping financial sanctions. Secretary of State Rubio explicitly called the tolling system unacceptable at a NATO meeting. If the tolling system remains a sticking point in negotiations, the strait may remain partially functional but commercially constrained, a state that keeps prices elevated without triggering the full ceasefire re-rating the market is currently pricing. Wood Mackenzie laid out 3 scenarios. Quick peace reopens the strait by June. Brent falls to around $80 by end 2026. Summer settlement extends disruption through September. Shallow global recession, prices remain elevated. Extended disruption keeps the strait largely closed through year-end. Brent could approach $200 per barrel. The market this week appears to be pricing somewhere between quick peace and summer settlement. But the crypto toll introduces a 4th state that none of the 3 scenarios fully models, a strait that is technically passable but commercially taxed, partially normalized, and legally contested. That state preserves a portion of the supply premium regardless of ceasefire language. For TSX Energy holders, the monitoring variable is not the ceasefire announcement itself. It is whether the tolling system survives the peace terms. If Iran retains any form of toll authority over Hormuz, the structural re-rating of Canadian energy as a non-toll, non-disrupted alternative remains intact. That was the original question at the opening of this analysis. Was the 46% TSX Energy gain a premium or a re-rating? The answer appears to be both, and the portion that is a re-rating does not dissolve with a ceasefire. The Idemitsu Maru that docked in late May is one tanker. The Keasley-Lissam's deal that runs through the 2040s is the structural answer. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.